Hello, and welcome to Advanced Option Strategies, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I am joined out in the chat by Cameron May, 20-year plus veteran of the financial markets, another great education coach, and one that you see quite frequently out here in the webcasts. And today, we're going to be talking about, since it's Friday, 0 days to expiration vertical spreads and the idea of selling those spreads. Hopefully we'll bring some understanding, maybe dispel some of the mythology about 0 day to expiration options. So that's where we're going to head today as we go along. But again, remember, you can ask questions in the chat. Feel free to ask those questions or leave your comments, whether you're watching the live version or the recorded version. But before we get into that mix, let's talk about a couple of housekeeping items that we need to make you aware of. Remember that options can carry a high level of risk. They are not suitable for all investors. Certain requirements must be met to trade options through Schwab. Multiple leg option strategies, like the ones that we're going to be talking about today, will involve multiple commissions. So you got to be aware of the cost of those transactions. With the long side of the option spread, investors may lose 100% of the funds invested. The short side has the potential to be assigned at any time up till expiration, other than in certain circumstances. And we're going to talk about one of those certain circumstances today. Now, spread trading must be done in a margin account. Make sure that you understand, especially in this particular topic, the characteristics and risks of standardized options. Everything we talk about today is simply for illustrative and educational purposes only. It does not constitute any kind of a recommendation or endorsement of any particular security or strategy. Now, we're going to talk a little bit about technical analysis in this discussion. Schwab does not recommend the use of technical analysis as the sole means of investment research. We're going to use the Paper Money platform. It is provided for educational purposes only. It is not a guarantee of future success out there in the real world, and it doesn't do certain things like facilitate the early assignment of short options. So be aware of that fact as you move your trading from paper money to live trading. Remember, investing involves risk, including the loss of principal. And we're going to talk a little bit about probability analysis. We're going to talk about past performance of securities. Remember that those are not guarantees of future success. And there is no guarantee that any particular strategy that we talk about will generate a profit or result in a positive outcome. So be aware of that fact. Also, remember, we're going to talk about specific strategies. And in this particular case, the 0 day till expiration option strategy. So this is going to be a webcast where you're going to want to pay attention to the things that I talk about when we discuss the risks of this particular strategy. Now that we've done that, one other thing I want to, this is a recommendation to you, this part of the discussion, and that is I recommend that you join me either in San Diego next weekend, the 19th and 20th, in Dallas, the 2nd and 3rd of February, or in Atlanta, the 22nd and 23rd of March, for our live, in-person, 2-day technical analysis and option strategies workshop. It is no cost to you. Those are the locations. You can click on schwab.com/events to register for those events. I'd love to see you there and have a good conversation with you as well. Now, we're going to jump into this discussion today. And the reason that this strategy kind of comes up in the advanced option strategies radar, not so much that the strategy of selling a vertical spread, meaning creating short vertical spreads, is an advanced option strategy, but because of the length of time to go until expiration in these options, it puts it into that realm of perhaps a bit more of an advanced strategy. It's a strategy that perhaps requires traders to understand some of the characteristics of options, especially as they get close to expiration. So we're going to discuss some of those considerations. We're going to talk about current market conditions. We're going to talk about this particular strategy, selling 0 days to expiration vertical spreads, and we're going to look at some examples on the Paper Money platform. So be aware again, of all of those risks that we talk about. So again, you've got Cameron May out there in the chat. Cameron can answer questions along the way. He's an adept educator and trader. He understands these strategies and ideas. So feel free to ask questions of Cameron along the way. Also, this is a great time as we make this transition over to the Thinkorswim platform to click on that subscribe button right down there at the bottom of the page so that you can stay connected to the Trader Talks webcasts channel. And by the way, if you happen to like this session, click on that like button right down there at the bottom as well. Now, let's jump into this discussion and the idea of a 0 days to expiration option. There is a lot of mythology around this idea, but a 0 day to expiration option, and I'm going to go over to, we're going to go over to the trade tab really quickly, and we're going to take a look at the S&P 500, SPX. This is an index. And so index options, again, remember, are settled into cash. They are European style in most cases, which means that early assignment doesn't happen. Assignment only happens at expiration. So that's one thing to consider. But remember, we've talked about index options in the context of using them as protective strategies. I teach a webcast on Wednesdays about protective strategies. One of the things that we talk about is using index options, but be aware of some of the differences between an option on an equity and an option on an index. Now, the reason I bring this particular index up in the context of 0 days to expiration is that you notice as you start to look at the expiration dates for SPX options that there's one that expires today. Now it's Friday, so weekly options typically will expire on a Friday. Remember that the Chicago Board of Options Exchange introduced weekly options all the way back in 2005. Options that expire on a different Friday than the third Friday of the month. So we have weekly expirations, but then based on, and then on and on and on and on. And you can see that those options, as you go out in this option chain, have, incremental days to go until expiration. So lots of granularity in terms of expiration dates. Now, in general terms, if you think about it, any option that is listed becomes a 0 day to expiration option on its last day of its lifespan, right? So any option on any stock, when it's on its expiration day, becomes a 0 day to expiration option. But we're going to focus on those that are quite substantially liquid, right? And there's a reason for that. So as we put this strategy together, we're going to begin with SPX options. We'll talk about some liquid individual stock options potentially as well. But keep in mind that there are 0 DTE, 0 days till expiration options that exist on any listed option, because when they get down to that last day, it becomes a 0 day till expiration option. Now, a couple of things really quickly as we think about this. 0 DTE options expire just after the market close. Generally, on something like the SPX, it's going to be 15 minutes after the market close when this when the SPX options expire. So what that does is, if you're trading a 0 DTE or 0 day till expiration option, by definition, if you're trading it in 0 days to go until expiration, there is no overnight risk because the trade is not being held overnight. It's being initiated and exited, or it expires in the same trading day. And so that removes overnight market risk. And we know that strange things can happen in the middle of the night that may move the market. Now, because of news, strange things can happen in the middle of the day to move the market as well. So be aware of that fact. Now, one of the other considerations here is that 0-day till expiration options have the same influences, price, time, and volatility as any other option, right? There's nothing that changes them from that perspective other than the sensitivities change. But they still have time decay because there's still some time value remaining. They still have sensitivity to changes in implied volatility. They still have sensitivity to things like gamma and delta, directional price movement. In fact, they may even have more sensitivity to those things, delta and gamma, than an option that is further dated out into beyond expiration. And oftentimes, because they become fairly liquid, those options can tend to be or have relatively tight bid-ask spreads, especially when we're talking about something that is, say, for instance, an index like the SPX that is quite liquid. Now, one of the questions is, when does that morning expiration close? You know what? I'm not sure. We'll have to look that up because I'm not sure exactly what that expiration time is of the morning option. AM settled, so we'll have to look at that. I'm not sure exactly what that. Now, Vaughn asks a great question, and this is a question that I want to address in this discussion, okay? Vaughn asks the question, what about the pattern day trader rule? And the pattern day trader rule, which applies to traders who execute 4 or more day trades within 5 rolling business days, which means opening and closing the trade in that same day. If that number of day trades exceeds that limit, the rule kicks in that requires the trader to maintain an account balance above $25,000 going forward. Failure to do that, or initiating and taking those trades off within that time frame. Thanks, Cam. I appreciate you looking that up. Falling under that pattern day trading rule, that may limit the trader and their account to only closing existing positions and not instituting new positions. So for those who are perhaps trading smaller accounts, this is something to be concerned with. Now, on an administrative note, if you think about it, though, if a trader opens a position and then closes that 0 DTE options contract on the same day, it counts as a day trade. And that's defining as opening and closing a trade on or a position on the same trading day. However, if the trade is opened and then allowed to expire worthless, it doesn't tick the day trade counter. So if the option is opened and then expires, that doesn't count on that that pattern day trading rule. So something to pay attention to. Now, here's the thing. These are short-dated options. They have the lifespan, obviously, of a mayfly, if you will, right? They live and die in that one day prior to expiration, and that is today in this particular case. So we know that the SPX can move, or whatever the underlying instrument is can move. So there is the potential for significant volatility. So it's important to watch and pay attention. This is not, and I'm going to say this again, 0 DTE options are not set it and forget it trades. So they are not for everyone, these strategies, this particular approach. It is not for everyone. It is something to be aware of in trading these strategies. And our intent here, again, not to recommend any particular strategy, simply to resolve or remove some of the mythology around 0 DTE options. Okay, and thanks, Cameron, for popping that in there in terms of the definition for imposing the PDT limits. Okay, so let's talk about this strategy and the idea, right? The idea is, hey, this almost becomes a binary situation. So if we look at these SPX options, and again, this is for illustrative and educational purposes only. Remember that index options are cash settled, so these are going to be relatively expensive. We look at these options that expire. and they expire at the end of the market today. And you can see that in terms of bid-ask price, relatively narrow bid-ask spreads. I'm looking at the put side. Let's look at both sides. And let's take a look at both sides. Whoops. Both. We'll filter for both so that we can look at both sides. And you can see that they've got relatively narrow bid-ask spreads. In some cases, penny-wide increments in the bid-ask spreads. In some cases, 5 or 10 cents wide in the bid-ask spreads. So again, slippage is going to be something that may need to be paid attention to. But you think about also what happens. The options essentially become a binary situation, right? It either is or it isn't, right? And as the closer you get to expiration, the closer those option Greeks get to that binary is or isn't situation. So at expiration, the option is either in the money or it's out of the money. There's not a lot of difference in between those. It is in the money or it is out of the money, right? Theta is, again, a binary, because we know that all of that time value, all of that extrinsic value is going to decay away and be gone at the end of today, right? So it is a binary situation. Same thing with implied volatility. Either implied volatility is going to rise or it's not. And so that impact is going to come or it's going to not be an impact. So one of the things that we might look at in terms of approaching this 0 day till expiration strategy, and there are many approaches to this. There are approaches that say buy long directional options out of the money and expect a big move because they're inexpensive, but you get a big bang for your buck if the price of the stock or the price of the index moves, right? But you're suffering from time decay. You don't have overnight risk. We're going to take the perspective in looking at this strategy of selling vertical spreads on 0 DTE options, of selling where the index or the stock is not likely to be, okay? Where it is not likely to be, and then allowing those options to expire. Now, you probably have heard me talk either on Your First Trade or in various webcasts or in the live presentations about the idea of closing trades down prior to expiration. In this particular case, we're going to discuss the idea, since this is an index option and it is European style, we're going to discuss the idea of allowing these options to go to expiration and expire worthless. That is our end goal in this particular strategy. So putting the trade together is the same as putting a short vertical spread together in any other expiration cycle. We're going to look for some of those considerations. So let's go back to the technical analysis discussion really quickly here, and let's go back over to charts. So here's the S&P 500 at the moment, and this is a longer term scale on this chart. This is a 1 year, 1 day chart. And we can see that the move that the SPX is making today is relatively neutral. As a matter of fact, it's only up about 0.17% today after gapping a little bit down to the open and just kind of hovering right there. So what I decided as I was looking at this is probably too long a time frame for me to put technical analysis to work for a 0 DTE expiration. So what I built was a grid that I titled 0 DTE intraday. And so I'm taking an intraday, today's movement, putting it into a 1 minute candle, and I've got on here the Rocket RSI. Now, I will tell you this, Cameron May, you guys are lucky because you've got Cam out there in the chat, and Cam teaches a webcast on technical analysis, and I'll let him pop the link in there, where he discusses a variety of different indicators, and I think he's covered the Rocket RSI on a couple of circumstances. But the Rocket RSI simply takes that regular RSI and turns it into a pressure gauge when it comes to sentiment. Above the zero line, positive sentiment. Below the zero line, downward sentiment or lack of sentiment, if you want to think about it from that perspective. So here's what we have on the SPX right now. I have a little bit of a resistance level from that longer term chart, but I noticed that the trend has been higher over the last 3 or 4 minutes as we've been talking. Price has been starting to move down a little bit. The Rocket RSI falling from a high and continuing maybe to move down a little bit. So a little bit of a lack of bullish sentiment here. So if we think about that, then what might me from a technical analysis perspective be thinking perhaps in terms of the strategy, selling a call vertical spread somewhere up here where the index is not likely to be between now and expiration. Is it going to be a home run trade? No. Is it going to be a trade that's going to pick up nickels or dimes? Perhaps. Yes. Is there a risk in the strategy? Absolutely. So let's look and see how we might put this trade together. What we're going to look at right now in this context is selling a short call vertical above where the SPX is that expires at the end of trading today. Okay, that's where we are from that perspective in terms of this strategy. So let me do this. I'm going to kill my annotation really quickly, and we're going to pop back over to the trade tab. Okay, so I've got a resistance level right here at about 47.90, and that's going to be my area of kind of that line in the sand barrier where I don't want the stock to cross or the index to cross and come back up. And as a matter of fact, we're starting to see that move to the downside. So let's go to the trade tab and let's take a look. 47.90 is going to be my line in the sand. That might be the point at which I sell that leg on this strategy, selling the 47.90. As a matter of fact, I did that a little bit earlier. I sold the 47.90 and I bought the 47.95. Now, let's just put that together right now as if we were doing it on the spot. So I left click on the bid price for the 47.90 and I left click on the ask price on the 47.95. And what I've built is a short call vertical with the short strike at 47.90, okay, at 47.90, bringing in $1.25 credit. So I've got a $5 wide spread, right? $5 wide spread. The maximum profit that I could bring in this trade, if this expires worthless, is $1.25. The max loss is $3.75 times 100 shares in a standard contract worth $375. So one of the ways to manage risk in this trade is not to create just a short call, which would put you in a naked position, but to create this as a short call vertical, which has a defined amount of risk. And theoretically, there is a defined amount of risk. Theoretically, the maximum risk in this particular trade is $3.75 or $375. And that would be incurred if at expiration, the price of the index has moved up and through this vertical spread, right? Up and through this vertical spread. The idea being that the price of the index may continue to move to the downside, okay? So $1.25 theoretical maximum gain, maximum theoretical loss. And this becomes an either or scenario, right? Because at expiration, the price of the stock or the price of this index, sorry, this is an index again, the price of this index is either going to be above or below that 47.90 where it is short, right? So that's the scenario. Now, could we, if we delete this, could we sell further away? Let's go back to the chart again. 47.90 is way up here. Could we sell a 47.95? Let's look at the trade tab. Could we sell the 47.95 and buy the 4,800? Whoops. Buy the 4,800. Yeah, 65-cent credit, again, $5 wide vertical spread. We take a look at confirm and send, making 65 bucks, risking 435, but we're further away, right? So this goes back to conversations that I know that Brent Morris has had in this particular webcast. And as a matter of fact, last week talked about the idea of selecting strikes based on your risk tolerance. Greater probability of success by selling the 47.95 and buying the 4800, higher risk, but greater probability of success. And that is indicated by delta as a theoretical proxy for likelihood of being in the money at expiration, right? We could, if we wanted to, since we know theta is going to happen over the course of today, we could change that theoretical to probability of in the money. So if we were to sell the 47.95, it's got about a 22% probability of being in the money at expiration. Okay. Yeah, and CL, it is a standard indicator in the Thinkorswim platform, the Rocket RSI. Okay, so what we're doing in creating these vertical spreads is playing that probability over a much shorter time frame than we would if we were creating a longer dated short vertical spread. So this is the point that I want to emphasize. What if we were to go out, say, for instance, 20 days to go until expiration? Let's make that February, let's go 21 days. Let's make that February 2nd, right? By the way, I'm going to be in Dallas teaching a workshop on that Friday, on February 2nd. So if we were to go back here and do the same thing, let's say we were to go out to the 30-cent delta. Let's add a few strikes here. Let's add 30 strikes. And we were to go out to, say, for instance, the 30-cent delta or even the 35-cent delta. And we were to sell the 35-cent delta and we were to buy so we sell the 30, that's going to be the 48.45, and we're going to buy the 48.50. Now we're bringing in $1.80 of credit. We click on confirm and send. You see that our risk and reward or our max theoretical profit, max theoretical loss percentages are just about the same. They're just about the same. But guess what? Guess what? In this particular option, we have 22 days to go until expiration. How far could the stock move, or this index move theoretically in the next 21 days? The answer to that question is right over here on the right-hand side under implied volatility. The implied move based on current implied volatility in the next 21 days is up or down 113 points. So is there still risk going out 21 days to go until expiration and being within that range? Are we within 113 points? Well, there's 48.50 and it's currently trading at 47.86. So we're pretty close, right? We're pretty close to that. Maybe just a little bit outside that range. So let's go back to the one that's expiring today. And I want to answer the question that Chris asks, which is there an optimal time of day to use this strategy? The optimal time of the day really, I think, comes from a look at technical analysis. When you understand or have a bias directionally about what the index is doing, right? Okay. Now let's take a look. And as we were to put this trade together, if we were looking at the possible move right now based on current implied volatility, it's plus or minus $10, $10.47. So if we look at this vertical spread that we built, 47.90, we're trading at 47.85. We're still within kind of that range, right? That expected move, we're within that range. So are we really, I mean, just let's put this into context, right? Risk is risk. The risk of the trade ending up in the money 21 days out is just about the same risk as the risk of the trade ending up in the money with 0 days to go until expiration. We're just doing this on a shorter time frame. So if you put that together and put that idea together, the possibilities, now you're going to see smaller credits. Because remember, we're looking at only $1.25 in selling this vertical spread. You're going to see smaller credits because there's a smaller length of time to go until expiration. There's less extrinsic value, but it becomes a smaller time frame that you're tied into that trade, and that capital is tied up to hold that position risk-wise. So if there's a binary event coming up, this could be potentially a way to trade that. Now, Jerry asked the question, why not sell the put spread instead? Well, let's see. Could we sell a put spread? In fact, I did both of those. I sold a put spread over here earlier this morning, and directionally, that becomes the scenario, right? Yeah. Sell a put spread if it's moving up, sell a call spread if it's moving down, and if it's neutral, create an iron condor, perhaps, right? So if we take a look at this particular spread, now we could do this again. If we were approaching this from the perspective of where are we right now, again, we're trying to sell the vertical spread where the stock or where the index isn't likely to be. Now let's go to the Analyze tab really quickly here and see what this looks like. I'm going to go over here to the SPX, and we'll take a look at this current position. So I'm going to take out there that single option. And notice what we have. If we kind of start to break this apart, I've got a short put vertical, I've got a short call vertical, and you can see that it creates that iron condor type of scenario, right? So what am I looking for? An expiration in between those two. If I were just looking at the call vertical like we talked about, here's what I'm looking for, is an expiration with the index below my short strike. If I'm just looking, whoops, there it is. There's the call vertical. If I'm just looking at the put vertical, I'm looking for an expiration above my short strike, right? Yeah, and Jerry, to that point, to not get hit with the pattern, with the PDT, the pattern day trade ticker, you've got to let the trade go through till expiration. Now, let me ask the question. Thea says this is a very risky trade. Okay, let's examine that for just a second. Let's go back and talk about this in terms of risk, okay? And this is the reason why we're putting this together as a short call vertical instead of just selling the short call, right? So we're going to sell in this case, the 47.90, and we're going to buy the 47.95, okay? Bringing in 70 cents of credit. We click on confirm and send. Bringing in 80 bucks against a $4.20 or $420 theoretical maximum risk. Now, because this is a European style index, there's not the possibility of early assignment. So if the price of the index moves in the direction that we think it's going to move, then this trade, if it stays below our 47.90 strike, or if it stays below our break-even point, then it becomes potentially a winning trade. If it goes above and puts the vertical spread in the money, then there is that possibility of taking that maximum theoretical loss. Is that different from a risk perspective than any other short call vertical or any other short put vertical or an iron condor where you have that risk on both sides? So the point is, in terms of putting this together, the mythology is 0 DTE options are incredibly risky. The reality is, if you understand the strategies that are being employed, then that risk is defined and understood, and then it's your choice to accept that risk or not. Now, that's on the SPX. And that is that possibility of using those short vertical spreads. Now, one of the reasons why traders may use index options as a means to facilitate zero DTE options is because of that European style nature and the lack of potential for being assigned early. The other is liquidity. But let's say we were to take a stock like TSLA, right? Tesla. And Tesla, from a directional standpoint, this chart is simply a today 1 minute chart. We can see that Tesla had been moving higher, but generally overall, 20 period moving average, which means a 20-minute moving average, it's staying in that downward direction. Now it's at a level of support, right? So could it bounce? Sure. But is it likely to make a big move up? Maybe, maybe not. Once again, selling the vertical spread where it's not, right? So let's look at trading this as an example. And again, not a recommendation in any way, shape, or form. But what if we go to the zero DTE options for Tesla and we look at selling a call spread, taking advantage of that directional downside movement? Now, again, this is an exceptionally liquid stock. Look at this, 102 million shares average daily volume today, right? And if we look at where is it? There we go, volume and open interest. There's a lot of volume. There's a lot of open interest in these options, right? So these are liquid options. Now, does that make them better or worse? It simply makes them liquid, and it generally would mean that the bid-ask spreads are narrower. Okay, so now we take a look at these options and we start to look out 2 or 3 strikes out to go until expiration. And remember, we're now in a couple of hours to go until market close. So a lot of that extrinsic value, a lot of that time value has already decayed away for the day. If we want to think about it from that perspective, is there a lot of value left in these? No, there's not. But if we think about the possible move, $1.76, the stock's currently trading at 217. If we were to sell, for instance, the 220 strike, we don't have a lot of granularity here. If we were to sell the 220 strike and buy the 222.50 strike, we're bringing in about 6 cents credit. There may not be enough juice here to make the squeeze worthwhile. So that may be a circumstance where, if there's an expectation of price movement in a particular direction, then some traders may use this circumstance to buy a long directional option, either slightly out of the money or in the money, with the expectation being that the price of the stock makes a move of a particular range, and there is some profit in that trade in terms of the pickup in intrinsic value. Because the closer we get to expiration, especially at the money strike, gamma becomes a big player in the option Greeks. So if the stock starts to make a big move, there's news. Again, it's a binary scenario. That option could move in the money very quickly. It could also move out of the money very quickly as well. So something to keep in mind. And we'll talk a little bit more about the buying options, buying zero DTE expiration options on another session. But I wanted to introduce this idea and and dispel some of the mythology. So CL asks a question: does the time value go away at the end of the day, right? Overnight move does not impact us. And that's one of the considerations in trading zero DTE, zero days till expiration options, is that there is no overnight risk, right? There is no overnight risk because the price of the stock is going to be either, it's going to be a binary scenario here in terms of that expiration, and we're not carrying that risk over into the next day. It's either going to expire and it's going to expire worthless, or it's going to expire in the money. It becomes that binary situation. Okay. All right. So just some of the things to consider in terms of this particular strategy. So that's one of the reasons why, in terms of looking at that that amount of premium that's still available here on a very liquid stock, that's why some traders may use these indexes as a means to facilitate zero DTE options. And one of the other things to think about, just in terms of practical application, if this is a strategy that a trader becomes adept at employing on an index like the SPX that has lots of expirations, meaning one every single day, then there are lots of opportunities to employ this particular strategy. But before we go, guys, I want to reiterate one more thing. Zero DTE options have a trading life of 1 day, so they lose their extrinsic value in that trading day. In a single trading session, even a minor change in the price of the underlying asset of a zero DTE option can greatly impact the value of the option before it expires. So not a strategy necessarily for the faint of heart. News can create an impact on these strategies as well. And keep in mind the idea that because they are short-lived instruments, they require close monitoring. There's significant volatility potential. Profits or potential profits can disappear quickly and even turn into losses with a very small movement of the underlying asset. But I wanted to bring this out and bring this together so that we can talk about it. Here are the two that I have. The one that I traded this morning, the short, this is our short put vertical, now trading for 50 cents or for 5 cents. The one that I sold for 90 cents this morning, the call vertical, now trading for 75 cents. So both of those working in my favor on the SPX. Still looking for that neutral movement going on. Nancy, to answer the question, the best time to trade this is when you see and have a good handle for the movement in the underlying asset. And while there is still extrinsic value to be used to create the trade. So again, I will tell you this, and James asked the question, you know, do people actually trade these? I'm going to wrap up with this. There's a reason for this. According to FINRA, in 2023, the number of opening zero DTE option positions increased by approximately 60% and accounted for about 40% of the option trades that are being transacted. Okay. For retail traders, that number is even higher. It's about 75% increase in option positions, and it accounts for about 45% of the retail option trades that happen. So guys, once again, thank you for having this discussion with me as we talk about these ideas. And this is something that is out there in the news. Want to make sure that we address some of that mythology and have a discussion about zero day till expiration options. So we talked about current market conditions. We discussed the construction of the strategy. We looked at a couple of examples on the Paper Money platform. And once again, guys, understand the risk and characteristics of these strategies before you employ them. Thanks again to Cameron May for answering questions out there in the chat. Thanks for being here. If you're in the archive, leave your comments and we will talk about that. And I'll try to answer those questions as best I can in the comments. But once again, thanks, guys. Have a great weekend. We'll look for you back on Tuesday, because remember, Monday is a market holiday, so no webcasts on Monday. And then if you want to join me in San Diego, I'm going to be there next weekend. Guys, thanks again. Thanks to our production staff for helping out today as well. Have a great weekend, and thanks for joining me.